So you are welcome to another session. In this session, we are going to look at the application of discounted cash flows. Now, when it comes to discounted cash flows, there are some things that you must understand when it comes to investment appraisal. And that is why do we try to apply capital investment appraisal techniques, or why do we try to use the discounted cash flow? It is all on the time value of money, all on the time value of money. So what then is the time value of money? The time value of money says that what money received today is worth more than that same sum received in the future because it has time value. Why? Because money that we receive today is going to change as time goes on. Why? Because that money could be put in the bank to earn interest. The same way, inflation may reduce the purchasing power of that money, and then there may be risk. The chance that that money may change, not so it may vary as time goes on. So there are three causes or three factors to consider when it comes to the time value of money, or three factors that cause the time value of money to decrease, right? So as you have values in the future, they decrease as time goes by because of these three what techniques. And that is why we consider this time value of money to discount money to the present value, telling us that the value, let's say, if you have money today worth 10,000 or so, and this 10,000, if I put it in a bank to give me interest of 10%, that means I'm compounding. Okay, so mostly when we are compounding, the future value is the cash flow that we have, one plus the interest rate in geometric terms, and also raised to the power n, where the f is the future value, the cash flow is the present value today, the r is the cost of capital or the compounding rate, and the n is the periods, the number of periods. Please, this is not years. It's not always that it's years. It's the number of periods given. Okay, so don't make it years. Some people use T, specifying time. So it's period. So if I have 10,000 now, and I decide to put it in a bank for 10%, and also for the next 10 years, what will be the value? What will be the value? So if I put 10,000 in the bank at 1.1 raised to the power 10, that means in the future, in 10 years' time, provided all things being equal, if I put this money in the bank for 10 years, then I should acquire 25,937 cedis after 10 years, right? This is the future value. But we are saying because of the time value of money, the value of this 25,937 will reduce with time. You get the idea? So this 25,000, if I should have brought it to today, how much value would it have lost to become this 10,000? And that is why we reverse this process. So you see here, it was what? Present value. It was what? Future value, which is the future amount, should be equal to what? My present value, 1 plus r raised to the power n, right? So if I want to get the future value, meaning I must reverse this process. And how do I reverse this process? By reversing this process, then I can say that therefore, I want this, what am I looking for? Now I want what amount 10,000, how I want what amount 25,000 will become after discounting it back to 10 years ago. What was the initial amount I put in the bank, right? So I'm saying that, okay, now I want to get the present value. So I know that I put what? 25,937 put in the bank, I get in or got in the bank, was as a result of some figure I put in the bank 10 years ago at 10%, not so. So I want to make P the subject. So what do? I just divide both sides by 1.1 raised to the power 10, 1.1 raised to the power 10, not so. And you realize that the present value now becomes what? The cash flow that I have over 1 plus R raised to the power n. And this is how we discount. But the same way, you can just, because A over B is just the same as A minus 1, you can just rewrite this as the cash flow times 1 plus r raised to the power negative n, okay, where this becomes the discount factor. So it's the same thing you are doing, but now you are deciding to what, simplify it. So if we are going to maybe put this to work, let me just explain one or two things. So using the same example, now what we are going to say is this, that, okay, now I know that my present value is the same 25,937, no, so by 1.1 raised to the power 10 years. Now, negative 10, right? Because now if we are compounding, you make it positive. If you are discounting, that means you want to get the present value. That is what? Negative 10, okay? Now, what you can say here is that, okay, if we convert this to decimal, what do we get? Okay, that's what we call the discount factor. Okay, it's just the same thing you are doing, but you are just simplifying it. So if I do on my calculator 1.1 raised to the power negative 10, I end up with what? 0.3855. And what does this mean? Discounting means that, you see, this 0.3855 means that in the past, this money was only worth 38%. Are you listening? The money we put in the bank would be only worth what, 38% of this 25,937. It means that 38.55% of this money should be invested to grow to 25,937 after 10 years, meaning that it would have lost value of how much? If you subtract 1 from this 0.3855, how much would you have lost? You would have lost 61.44 of its value over time. This is what discounting means. You get it? So it means that we are losing that value. So when you are discounting something from the future to the present, you know that the future will only have inflation and other things embedded in this, right? And if you don't take care, you might make rash decisions. So let's take a simple example. So let's say I want you, look at this. I want you to invest 100,000 today, right now, which is year 0 in finance, and you are going to get 500,000 in 5 years, let's say in 3 years time, also in 3 years time with interest at the same 10%. Let's see if this investment is worthwhile. Now, there are two options, right? So the reason why we do net present value is that, okay, should I invest this 100,000 in the bank and earn this 10%, or I should invest it in this your project, right? I should invest this in your project and still get the same 10%. I get it. Or your project should offer me something better than the 10%. So let's see. I want to give you a first scenario. Let's shift all the money into the future and see. So if I decide to take the initial investment and see how much it will be worth in the future and compare it to the 500,000. So this one means initial investment, if I invest in the bank, right? If I invest in the bank, so this is how we used to do investment appraisal before this new approach came. So if I decide to invest in the bank, that means I'll put this same 100,000 in the bank at 10%, right? 1 plus 0.1 for the what? For the same 3 years, and see how much it will be worth. Let's see. So 100,000 will grow by 1.1 raised to the power what? 3. And that gives me only 133,100. This is what the bank will give me, right? This is the bank. But in the project, which is also in 3 years' time, you see, this is 3 years' time. The project is also in 3 years' time, and the project is promising me what? 500,000. So which is better? 133,000 in 3 years against 500,000 in 3 years. Which is better, the project or the bank? It's obviously the project, because the project has 500,000 now in 3 years and 133,000 in 3 years. But because the future is uncertain, we don't want to use this approach to assess the bank and the project, right? Though we see that the project is profitable. Instead of looking at sending this bank amount in the future, comparing this future bank amount to the value of the project in the in the future, because of the time value of money, we know it will decrease as time goes by. So why not rather bring what is in the future to today's terms to see how much is lost in value? You get the idea. So what we will do then is that, okay, now that 500,000 will be brought into the present so that we consider whether the project is worthwhile. So this is what we are going to do. We are going to say that, okay, so if I get the present value of the net cash flows I'm getting from this project, that is the project, right? And compare it to how much I invested today, what would it be worth? So we are saying that, okay, now this project was worth 500,000 or so. I want to get the present value. And I've already told you that the present value is got as a result of what the future value, which is the cash flow, times 1 plus r raised to the power what? Negative n. Please remember this. Negative n when you are discounting because you are going to the past. And when you are going forward, you just make it n. Please remember this. So in that case, you see the first illustration, I was sending it to the future. So it was n, but now it's negative n. So the cash flow was what? 500,000 is what I'm getting. Now this 500,000, if I should discount it at the same 10%, minus what? I'm going back to 10 years ago, right? Was it 10 years or 5 years? 3 years, sorry. This example was 3 years. So I'm going back. That's why it's negative. You are returning. So plus 3 years or minus 3 years, meaning I'm going back to the past, right? So if I'm going back to the past, then let me just convert this. I told you to always convert this. This is what we call the discount factor. Okay, so we have 500,000. We have 1.1 raised to the power negative 3. And mostly the discounting tables uses 3 decimal places. So I have 500,000 would only be worth 75% of its value, right? Meaning it has lost about 25% of its value. So every year, that means that as the years go by, you actually lose what? A percentage, about a quarter of 25%, right? So for 3 years, you would have lost 25% of the value of whatever amount you put in the bank. That is what it means. I'm going the finance, but that is the assumption. It's not just formulas that we use. It actually makes literal sense that as time goes on, you lose. So it's only worth 75% of its value. So if I put in 500,000 at 75% of its value, that means I end up getting 375,500 today. That means that this is what should be put in the bank, and also to get 500,000 in 3 years. You see, so you should have put 375,500 into the bank to get 500,000. But the person said only invest what? 100,000 today to get this same 500,000. Meaning, is this investment good or bad? It's good, because instead of investing 375, he rather told you to invest 100,000 in his project, not the bank. The bank, you would have invested 375 exactly, right? You would have invested 375 exactly to get 500. But this guy's project said invest 100 and you can get the same 500. So it means that this guy's project is better than the bank. By how much? And comparing it to the bank, that is what results in what we call the NPV, the net incremental cash flow, or the net present value. So in that case, we are saying that, okay, so if I decide to put in here the cash flow, the discounted factor that I got at what? 10%, and then the present value, I know that the money I invested today is worth what? 100,000. And 100,000, because it's today, if I should get the discounted factor, or the discounting factor, is year 0. So if I do minus 0, 1.1 raised to the power minus 0, I get 1. No, so I get 1. So if I multiply, I still have 100,000, which I will invest today. But in the future, which is in 1 year's time, if I should bring it to today, I should have invested 375,500 in the bank, or literally that's the cash flow that I'll get if I should have invested today. And that one was the present value. Let me give you the actual cash flow. That means that this 500,000, I would have what? Invested 100,000 today, but this 500,000, if I get it, it means that I would have 1.1 raised to the power minus 3, 0.751. It means I would have invested 375,500 today. And that means that this project is better than the bank by how much? You get the idea. So that is it. So the MPV is by how much the bank is better than our project, or our project is better than the bank. So this project is better than the bank by 275,500. Okay. So that is what MPV means. And I hope now it makes sense. Because if we are saying that, okay, this 500,000, how much should be invested today to get this same 500? It's 375. But we are saying invest 100. That means it's a 2-4 ball. You are gaining. You are getting it at a cheap price. So that is the gain, the net, which is actually maximization of shareholders' wealth, because this is actual cash. Not so? Yes, this is money that you end up saving. Okay. So that is MPV. I hope it makes sense. So in simple terms, because MPV is usually the key investment appraisal technique you'll be using, I want you to see MPV, net present value, as the present value of your cash inflows, okay, the cash inflows you are going to get, just like what we did, minus the present value of your cash outflows. Now, under normal circumstances, you are going to see what? Initial investment. Now, note, it is not always that your initial investment or your initial outlay is the only outflow. Some questions, you have multiple outflows. So just know it this way. So let's take some particular projects and let's understand the concept of MPV. MPV also has other techniques that support MPV, which is, let me give you an example, is profitability index, which tells us what? How much profit, or in simple terms, MPV, is generated for every 1 CD of cash outflow or initial investment, okay? For every 1 CD of initial investment. So you can calculate it. There are two methods. So you can calculate your profitability index. Okay, it's an index of profitability. So how much do you generate for every 1 CD you invest? So I can get it as my MPV over my initial investment. Okay. So with this method, if PI is greater than 0, then accept the project. If it's less than 0, then reject the project. Okay, so these are the two things that you have to look at. PI also has another formula, which instead of MPV, we use the PV of cash flow. So here we can take the PV of our cash flows over our initial investment. So how much above the initial investment does the PV generate? That's another one. So here, when PI is greater than 1, you accept the project. If PI is less than 1, you reject the project. So for a single project, yes, for multiple projects, you look at the one with the highest PI. So I always tell you single project, multiple projects. Okay, so that is about discounting. I'll come and teach you constant cash flows and how to deal with them. But now what I want to talk about is MPV, basic MPV question. And let's just solve. Let's just use this simple example to work MPV. Or in simple terms, we can look at the first example that we had, okay? The first example that we had. So MPV has its own approach. You can decide to discount this way when the net cash flows are given, or you can have an alternative. So for the first example that we saw earlier on, The first example that we saw earlier on, we can use that same example. I don't remember the cash flows, but we can use it to assess the investment. Where is it? Where is it? Where is it? Where is it? The very first example that we saw, I think, no, it wasn't this one. Yeah, the very first example, we can use it to calculate NPV. Yeah, this was it. The example that we used to solve the ARR and the payback, we can use it to solve NPV. Let's see if we can get NPV here. So this is how, because of time, usually people usually go straight, and they say that the cost of capital of the company, which is the same as the discount rate or your interest rate for the appraisal, right? So we are saying that, okay, so to get the net present value, this is what we are going to do. First of all, we are getting the net cash flows. And most of the time, most questions at your level will require you to go and calculate the net cash flows yourself. And we are going to take a simple example just after this one. But this one, it was straightforward. So in that case, we bring our year, we bring the cash flows or the net cash flows because it's net, okay? Then the discount factor at, mostly you write it in full, 10%, then our present value. So what I'll do is that, okay, if I take year one, so there are many ways you can start with year zero, which is your initial investment today, right? So year zero, I put in what, 100,000, and 100,000, I know that in the first year, which is 1.1 raised to the power what? Because this will be what? 1 plus r raised to the power negative n. So you just put it in the formula. And this one, when you do it, any number to the power zero is 1. So that means that you still have 100,000 worth of investment. They are saying invest 100,000 today, but then in year one, you are going to receive what? 50,000. These 50,000, how much would it be worth today if you should put in the bank? Get the idea? How much would it be worth? So if I do 1.1 raised to the power minus 1, I end up with 0.909. Also, so if I multiply this, that means I only lose 10% of the investment in the first year. So 50,000 worth by 0.909. That's 45450. 45450. Now, if I go to year two, if I put in the 100,000 in year two, I'm getting 40,000 again. 1.1 raised to the power minus 2. You get the idea now. So I'm not going to be writing the 1.1 again. So I have 0.826, 0.826. So I have 40,000 by 0.826. That's 33,040, 33,040. Then I have 3, which is 30,000 at 30,000. Also going for 0.751. So I multiply 30,000 by 0.751. That means you lose about 25%. That's 22,530. 22,530 year 4. Year 4, I have 25,000. So I have 0.683. 0.683. And year 5, I have the same 25,000. You know it's 25 because you receive 20,000 plus scrap value of 5. Not so, just all income. So that one go for 0.6. 0.621. Okay, so now we multiply, we have 25,000. 25,000 by 0.683. That's 17,075. And we have the same 20,621. We have 15,525. 15,525. Okay. So the same way, you can get the NPV straightforward here by adding all these cash flows and subtracting the initial investment. Also, which means that if you do 45,450 plus 33,040 plus 22,530 plus 17,075, plus 15,525. That gives you 133,620. No, so then you less your 100,000. That means you have 33,620 positive. And once it's positive, that means that this investment is helping you save about 33,620 as compared to the bank. Or you generate excess of 33,620 above if you should have invested in the bank. So simply MPV could have been what I said is the PV of your cash inflows minus PV of your cash outflows. Not so? So in simple terms, we have 133,620 minus 100,000, which results in a positive MPV of 33,620, which means that we should accept the project. Now, you don't do children interpretation that because it has positive MPV. I've explained to you that that means that this creates shareholder wealth because it is excess above what the bank has to offer. I hope that is very clear. Yes, so this is one thing that I want you guys to know and understand. So that is basically how we get NPV. So let's try to work with payback. Let's try to work with payback. Let's try to work with payback. So how do we get payback for this investment? So getting payback for this investment is quite easy. Okay. So that is what we call discounted payback. We've already done payback. Another method is where we discount the figures because before we do discounted payback. No, so for discounted payback, what you need to do is that you need to discount the figures before you do what the payback. So I'll do year, I'll do cash flow, I'll do discounting factor, I'll do PV. Then finally, I do the net cash flow that we have been doing. You remember? So now year 0, I invested 100,000 also. Discounted factor was 1, and that gave me what? Still 100,000. That means that when I go net, they are still owing me what? 100,000 also. Because this one you discount before you do the payback. Go to year 1, you receive 50,000. Now 50,000, it was 0.909, and it gave me what? 45,450. Now this 45,450, if you have 100,000, you take out 45,450, it means they are owing you 54,550. Okay, so this one means they are still owing you 54,550. Now, in the next year, you receive 40,000. Also, but this 40,000 is in the future. So why not bring it to the present 0.826? And when you bring it to the present, I think we are 33,040. So that gives us 33,040. Also, now this one, you owe 54,550. Now you pay 33,040 out of it. That means you are left with 21,510. No, so 21,510. When are we going to pay? The next year we receive 30,000. This 30,000 is in 3 years. We want the value today. So 0.751. And when we go back, the figure that we got for this was 22,530. So 22,530. Now 22,530 can pay 21,510, right? Yes, it can pay, and you will be left with a positive 1,020 cedis. So this tells us that this investment also can be paid after 2 years because that was the last year before it became positive. And this 21,510 was paid out of this 22,530, meaning our discounted payback, just like we did the other payback, the discounted payback is simply what? 2 years plus 21,510 over 22,536. Also, or 530, sorry, 530. So in that case, that means your payback is 2 plus 21,510 divided by 22,530. That means you have 2.95 years. That means it takes you 2.95 years to recover your initial investment. But if you want it in months, you can multiply the whole thing by 24. So you have 2.95 by 12, sorry, by 12. And that means it will take you 35.4 months. Or you can just multiply the 0.95 by 12 to get the months, which will be 11 months. So 2 years, that'll give you 2 years, 11 months to get back your initial investment. Okay, so this is discounted payback, just like payback. Now we need profitability index. So I am going to go this way. That profitability index, I'm going to use all the two methods I taught you. The first one, I'll use MPV per initial investment. MPV per initial investment, okay? The MPV for the initial investment. And if we are doing this, we know per the question that the MPV that we had was 133 something. 133, hey, it was 33,620. So in this case, we have MPV of positive 33,620 divided by initial investment of what? 100,000. And this tells us that we generate 33,620 over 100. That means we have 0.3362 for every 100 invested, right? That means we generate what? 33.62 Ghana cedis for every 1 cedi of MPV, 33.62 net present value for every 1 cedi invested in this project, right? So in that case, you accept because what? 0.3362 is greater than what? Is greater than 0. Remember, I told you that with this method, if PI is greater than 0, you have to accept the investment. Not so. So that is it. Now, the next one is where I'm giving you all the different alternatives. Where I consider PI equal to the PV of your cash flows over your cash inflows over your initial investment. This is how much your cash inflows generate over the initial investment. So with this one, we are seeing that your total cash flows is 620 over your initial investment of 100,000. That means this one gives us 1.3362, not so, which means that since your PI is greater than 1, you accept. No, so you accept this project because for every 1 cedi that is put in the business, you get what? That 1 cedi plus an additional 33,620. That means it's a good investment. We should accept it. Okay, that means it's a good investment. We should accept this investment. Okay, so that is profitability index, very simple technique. Okay, before I come to cash flows, which are not consistent and so on and so forth, I have to look at one final technique, which is internal rate of return, IRR. Internal rate of return. Internal rate of return. Now, internal rate of return, also known as the break-even rate. So it has a lot of names. We can call this the break-even rate. We can call this the hurdle rate. We can call it the gross yield or gross redemption yield. We can call it the yield to maturity. That's when you're dealing with bonds, yield to maturity. We can call it the effective market rate if you are doing financial reporting. Effective market rates for financial instruments. Okay, so it has a lot of names, but the whole thing is that this is the maximum rate, okay? This is the pure finance definition. This is the maximum rate a project can offer, okay? Just know it like this. Hence, we say that this is the rate, we say hence the rate at which the project breaks even, right? Because that's the highest return. So if you compare it to your initial investment, it should give you 0. So the rate at which MPV will be equal to what? 0. So why do I say this is the maximum return a project can offer? Let's take an illustration. Let's take an illustration. So let's say that in a particular project, the maximum return which the project can give is 20%, not so, but shareholders want 10%. Is this project worthwhile? Yes, it is worthwhile because the maximum return that it can give is more than what shareholders require, meaning that you can give them their share, which is the 10%, and still have an extra 10% to reinvest into other things. So we say where IRR is greater than what the target rate, also, or what the investors want, you accept the project because it means that the maximum return the project can give is more than the investors want. Now, when you go the other way around, what if the maximum return the project can give is only what 5%, but shareholders want what 10%? So if your maximum you can give is only 5%, then I won't accept because I want 10%. I will lose. So we say where IRR is less than the target rate, you reject the project. Okay, so we are saying that in simple terms, this is the most important concept that you have to know for IRR, that if I should plot cash flow, so cash flow or simply NPV, NPV is cash flow. If I should plot cash flow against the discount rate, okay, the discount rate or your cost of capital on a graph, you realize that they move in a negative fashion, right? And at the point where NPV and the discount rate meet, that is where we call the IRR. So you can notice that it's just like demand curve. The higher the demand, the lower the price. Not so? Just like that. There's an inverse relationship. There's an inverse relationship or a negative relationship between what? IRR and I said IRR, discount rate and cash flow, or discount rate and NPV. So the higher the discount rate, the lower the NPV. Meaning if your discount rate is what? Higher, then mostly you have a negative NPV. But when your discount rate or your cost of capital is lower, then you get what? A positive NPV. Okay. So IRR, you are just testing two parameters. Are you getting it? So we call it interpolation. You are testing two parameters on the line. Okay, usually we use trial and error to get no IRR you ever get is correct, but a negative value and a positive value will help your interpolation. Okay, that is why they came up with a formula that can help you get a value which is a bit equal to the actual answer. So there are many ways, but I want to make the formula simple so that you can always get it. Some people never get IRR correct. So this is what I want to do. So this is what you will do. You take the NPV of it doesn't matter. So we can say NPV A minus NPV. I'll not use this one. I just want it to be too simple. So let's say rate, let me make it rate, then it makes sense. Rate A, or let me just make it rate B minus rate A, all by NPV of rate A. Okay, so N A, NPV of rate A, all over NPV of rate A minus NPV of rate B, all plus rate A. So this one, I've really changed the formula now. People are not used to this. The common type that we see is where you have A plus NPV of A all over NPV, all over the NPV of A minus NPV of B, all times B minus A. This is it. But this one, people never get it correct. So that is why I've summarized it for you. Okay, so that you know where always define your formulas. Where NA is MPV of maybe the lower rate. It doesn't really matter whether lower or higher rate. The whole thing is that the rate at the top should be, its equivalent rate should be here. So if you have NA here, if that one is your higher or lower, it doesn't matter. If you have something here, that same rate should be what is here as the rate. So MPV of the lower rate, if you have NB, that's MPV of the higher rate. Okay. And RA being the lower rate. So RB will be the higher rate. So it doesn't matter what you use. There are a lot of formulas, but this one has simplified it that with this one, you can always remember. So instead of going this way, if we want to go, you could just make it IRR based on the interpolation formula should be B minus A. Okay, B minus A times MPV of A all over MPVA minus MPVB also all plus A. Now this makes more sense and easier instead of using RA. So this is comfortable. Okay, now we know the parameters already. Now the whole thing is that because IRR is trial and error, you need two rates. And that doesn't mean the two rates should start with what you have in the question. Some questions will not give you any rate. You can decide any rate. So far as it's two rates, you should get an IRR. Okay, so please note, it's not every question that will give you the rate. You can suggest any rate. So per this question, we use 10%. I can decide to do between 15% and maybe based on that, I would calculate another rate. Okay, but because the reason why most of the time we start with the rate in the question is that we've already used it to calculate the MPV. So we have one MPV already. And the MPV we had was positive. And I told you that there's an inverse relationship between MPV and discount rate. So if the MPV was positive, meaning was higher, that means the discount rate we use should have been lower. That's why we had positive MPV. So now we want a negative MPV. So per this question, I could say that we have what MPV A to be what? The 33,620. No, so it was positive. That proves that this is higher MPV, meaning the discount rate, also, which was A, was lower, also because it was 10%. This means that discount rate was lower because there's an inverse relationship. Now, if I want to get what? A negative MPV, that means I have to increase the discount rate. And also, I have to increase the discount rate. And increasing discount rate means that I will take my B, which is my discount rate, okay, because 10% gave me a lower MPV, gave me a higher MPV, then I will just try maybe 30%. You can go as further as possible so that you can get a negative figure. Okay, so maybe I can take 25%, okay, as my new discount rate. So what would the MPV be at the B? No, so I don't know. So I have to use the same table to get that MPV. Okay, so you construct your MPV. So I'll say, yeah, cash flow discounting factor now at what? 25%. Then I need my present value. Okay. So in that case, I know that in year zero, the investment is still 100,000, and this will be what? One. Still giving me 100,000 or so. So if I go to year one, I'm receiving my first 50,000. And now I'm doing 25%. So I have 1.25 raised to the power -1. So this one gives me 0.800. Okay, so that means you lose 20% of your original value. So 50,000 by 0.8. I have 40,000. So I lose 10,000 of the money in a year's time. Not so. So if I should go to year two, I receive 40,000 also. So 40,000, how much would it be? So I receive it becomes 0.640. So 40,000 divided by 0.64. I receive 25,600. I receive 25,600. I go to year 3, 30,000. 30,000. I receive 0.512. So 30,000 by 0.512 gives us 15,360. 15,360. So when I come here, it was 25,000 in year 4. So I have 0.40410. 0.410. So 25,000 by 0.410. 10 to 50. 10 to 50. Okay. Then I have 5. Also 25,000. 25,000. For this one, 0.328. Okay, which is 25,000 by, that gives you 8,200. So if I should put this together, look at my MPV I now get. So I have 40,000 plus 25,600 plus 15,350, 15,360 plus 10,250 plus 8,200. You get 99,410. So if I take out my 100,000 from this, I end up with negative 590. So this tells me that the IRR will somewhere be between 24 to 26% thereabout. Okay, 24 to 26, 27. It's within, because this amount needs some small chance too. So somebody can just even take the IRR as 25%. That means the maximum that this project can offer is 25%, right? But the project, the investors want what, 10%, meaning this project is worthwhile. You could just go that, but that is not what we planned, right? So we need IRR, and IRR here, we know that we are using what, B minus A, not so, by what, MPV of A all over what, MPV of A minus MPV of B, all plus what, A. Okay, so whichever one you take as your A, its corresponding should be here. Okay, so now I know my A was 10%, no so, and then my MPV of A was worth how much? 33,620 positive. Then if I take B, I know B was what, 25%, and MPV of B was worth how much? That's negative 5, was it 590? Yeah, negative 590. So if I have to do my IRR, I can just say that, okay, I know that B, which is the highest, was 25 minus 10. You can also use decimals, no problem. It's interpolation, it will work. Times the MPV of A, which was 33, what, 620. Now, so this is what we have at the top, all plus what? A, which was 10. So this one I have to minus what? 33,620 minus 590, so plus 590, right? So you see, when you do it like this, IRR becomes very simple. So in that case, then I know 25 minus 10 becomes what? 15 times 33620. So 15 times 33620. I have 504,300 at the top, 504,300. Then I divide this by 33,620 plus 590. That's 34,210. That's 34,210. Okay, so you see now IRR becomes very simple. Whatever I get, I now add it to the 10. So I have 504,300 divided by that, and that gives me what? 14 14.74 plus 10, right? So that means my IRR is equal to 14.741 plus 10, which will give me what? 24.74%, right? And you see this was equal to or equivalent to the 25%. That means the maximum. And also the maximum rate or the maximum return this project can offer is 24.74% or 25. But shareholders want 10% also. So we accept this project because the IRR is greater than the target rate that the investors want or the cost of capital. So we must accept the project. Okay, so that brings us to the end of the basic investment appraisal. You've learned IRR, MPV, PI, discounted payback, and ARR profitability index. So in subsequent videos, I will teach you how we can estimate relevant cash flows. I'll teach you how to get the effect or use the effect of taxation, working capital, and inflation, as well as post borrowing costs and other factors like contribution, foregone opportunity costs, and other relevant costs.